So you fine-tuned your forecast for CPI next week. We have seen an uptick in month-over-month energy prices. How is that going to feed through to the final numbers?
Yeah, that's exactly right. We project energy within CPI will be up 2% on the month in January. That's largely a response to the upward move in gasoline prices. We think that means the headline rate of CPI will rise 0.4% on the month, or 6.1 year on year. So that would be an acceleration in the month-on-month pace, but certainly another decline in the year-on-year pace. But we do think energy will add to a fairly solid inflation report in January.
And so where do you come down on the question of whether we really do have downside momentum in inflation? In other words, can we start to project ahead in coming months that it's going to be somewhere close or, within range of, say, the Fed's target area, or is it going to get sticky at some point?
We're of the view, certainly, that we've passed the peak in inflation, and year-on-year rates of headline are likely to continue to move lower. But we would suggest caution in terms of saying the battle is won, because right now most of the disinflation, it's narrowly driven. It's almost all coming from goods like new cars and used cars and household appliances and so forth. It has not yet reached services. So you need a broader base slowing in inflation to make us comfortable that inflation will be more, say, consistently back to 2%, and services historically is sticky. So I think it's too early to say we're out of the woods, but we're moving in the right direction.
Right, and of course, Fed Chair Powell has been pointing to, I guess, services ex shelter, because we know that there's a big lags in the shelter readings. I guess the question is whether the job market really has to weaken up very much, or you have to have wage growth really come down a lot more beyond what already has happened in order to be confident that services inflation is going to calm down as well. That seems to be, the big question that the market was recently feeling better about, that maybe the Fed didn't feel like they had to get unemployment much higher, but now I suppose it's still a question.
That's right. It is an open question. We come down on the side of thinking we probably do need some softness in labor market conditions in order to get the Fed fully comfortable that inflation will return to 2%. But you're right, it's an open question. The labor market is extraordinarily strong. We added 4.8 million jobs last year. The unemployment rate is at 5-decade lows. So that certainly is contributing to the high rates of inflation we're seeing currently.
And then, the folks who are very confident that a recession waits for us somewhere in the next several months keep pointing to these indicators that have rarely failed, right? The leading economic indicators, the ISM, the yield curve. All that taken together, does it tell the story that we're pretty much beyond the point of hoping to avert a recession?
I don't think so. I mean, we are in the camp where we think it's more likely than not we will see a slowdown in the economy, broadly consistent with a mild recession. That does kind of fit our view that to get inflation down to 2, you need to remove some of the imbalances in the labor market. But I don't think it's a done deal. I would caution against overreading one or two specific recession indicators and saying, oh, it's done. Household balance sheets are pretty strong. The labor market is strong. So there's momentum in the economy right now. Resilience is more the word than a slowdown. So I wouldn't get too far out in front of that right now.
Yeah, somewhat reassuring. Yes, the balance sheet story for sure. Michael, good to talk to you. Thanks so much, Michael Gapen at B of A.